Hello, my friends. I'm very glad to be here with you today. I will read you a little bit of book in Business for Yourself by Bruce Williams. And in a way, I'll have my coffee. It is instant U-Band brand. With milk and sugar. I like it. So, we were reading a chapter 2, Getting Started. And important considerations. We finished last time locating your business, and it was about visible or not visible. And I'm reading this book with you for the first time. And you're welcome to ask me in the live chat anything you like. You can send me a links to your channels, and you're welcome to subscribe to my channel. I will be glad to look at it. Hi. Write me here. I'll be glad to know you better. So let's see what we are going to read today. It is about leases, right here. Chapter 2, Getting Started, Leases. And let's see what we can find interesting in this book. I also want to tell you that if you have some other book for me to read to everyone, I will be glad to do that and talk about it or answer some questions. I really need your help on your opinion and anything you like to say. Okay, let's start. Leases. You build a great business and you want to sell it. You look at your lease and it says you can't transfer the lease. You can't sell it. A lease is a two-edged sword. Remember that before you get into it. Remember that before you get into it. The lease has its advantages. You can't be summarily kicked out. Landlords as a class aren't stupid. If your landlord watches your ice cream parlor turn into a huge success and you have a 1-year lease, he may decide not to renew it and go into the business himself. Can you imagine that? Sounds kind of cool for the landlord. So, in that sense, you have some protection with the longer lease. But, do you want to sign a 10-year lease? 10-year. Sounds good to me. If it's for $1,000 a month, you've committed yourself to $120,000. The enormity of it staggers. And here you should certainly have a lawyer at work, looking for the little one-liners that can sink the Titanic. You know, that sounds scary to me now. First, very impressive. Okay, 1,000 a month, then 120,000, 10 years lease. And now, one line can sink the Titanic. Anyone who signs a standard landlord lease for a commercial property without having a lawyer look at it ought to have his head examined. So, have a lawyer at work, huh? If you are not the lawyer, then you need, even if you're the lawyer, still, you know, one head is good, two is better. It gives the landlord everything except rights to your spouse. That's why it's called a landlord's lease. When you take it to your attorney, he will cross out paragraphs 27, 32, 34, and 44 and add paragraphs 73, 74, and 75. He will explain the implications of these clauses to you. The paragraph, for example, that makes you responsible for any improvements required by any government agency. That means a sprinkler system, a fallout shelter, or whatever the government demands. So, do you want to improve a sprinkler system for the whole building around? Maybe there are 10 more people. Then that's not bad. Well, thank you very much for coming over today. Let's see. Yes, I will name this video in the right way. I see the live stream health going from green to orange, kind of changing. I don't know why. Okay, let's continue. A lease means you cannot move into larger quarters if your business takes off. It may mean that you are stuck in a shopping center after the anchor store, the big department store, has gone out of business and the place has become a ghost town. There is nothing in the lease to protect you, and the center owner, believe me, has other problems to contend with. In many cases, when you get a lease, all you get in allotted space is the partitions. Oh, okay. The rest is up to you. And in some cases, you have to leave it behind when you leave not counters or refrigerators, but improvements to the interior. Read your lease. Often you can negotiate within a lease. Suppose you are negotiating a 3-year lease. You have confidence in your business and you are sure it will prosper. But what if the unexpected happens and you are sitting there with a lease with 2 years left to run? While negotiating, you can write in a buyout clause, perhaps expressed in terms of 3 months' rent. By paying it, you can get out of the lease. However, if you're looking for an escape hatch, the landlord will probably want the same. If he gets the same thing, he can buy you out by letting you have 3 months free rent, and then put his brother-in-law in the successful ice cream business that you started. Brother-in-law. Okay. In most shopping centers, signing a lease brings on a host of other obligations. Some people don't realize that in addition to the rent, they will be assessed for a share of the local property taxes, billed for their share of the cost of plowing that huge parking lot when it snows, billed for cleaning the lot and perhaps for private security guards. And if you make over a certain amount in a month, the mall may be entitled to a percentage of the excess because, after all, you're making money, so they should be making some of it too. They want to plow the parking lot from the snow. Okay. This may be important to check if you run a sale. Suppose you're selling some goods at a loss just to move them out, and you thereby attract a lot of additional businesses. The mall takes a part of that. Even though you're losing money. So maybe instead of running a sale, you ought to take the goods to a liquidator. Maybe you should, but maybe according to the mall contract, you can't. Read the lease by yourself too. Or you give it to your lawyer to read. Who will be responsible after that? The lawyer or you anyway? Okay, and a little more coffee. We're reading a book in Business for Yourself, right here, by Bruce Williams with Warren Sloat, and we're trying to learn something new, find something interesting, and have fun for 10, 20, 15 minutes. Here it is. You can't. Malls are rarely negotiable for the little business. You get the standard contract. Take it or leave it. If you do find that you have some leverage, it probably means the mall is doing poorly. Yeah, maybe there are not enough people in that mall, you know, and you don't need that mall. Well, if you have your thoughts, please let me know. You can write me in the chat, live chat. I kind of like that this has live chat now, you know. I didn't know that. Hi, live chat. Hi, live chat. That YouTube has live chat before I registered here. Now I know. Kind of interesting, you know. Okay. You know, this paragraph finished about leases. So, we read leases in chapter 2, getting started, and they say, read your leases. Read it carefully about your small place somewhere or in a mall. If it's in a mall, there are advantages and disadvantages. And somehow he finished this paragraph in a strange way, in my opinion, but maybe a mall is doing poorly. And maybe mall doesn't have enough money. Maybe they don't have enough parking lots. Maybe they don't have enough communication, transportation going to that mall. So people don't want to rent it. People don't want to go there. So you check it out. Check the transportation. Check who lives around. The people who work every day, who? Or there are only offices around your mall. Who will buy your stuff? Okay. Let's try to read purchasing an established business. So if you're not a starter, but you're a starter on an existing business, you're still a starter, I think. That's why this is in the getting started chapter. Okay. Why is the business for sale? Why is the business for sale? One of the first questions that must be addressed when you are buying a business is, why is the present owner selling it? You know, it's about anything that is for sale. Be advised that the answer you get is not always the real reason. Often as not, it's horse feathers. Frequently, the real reason is perfectly acceptable and would not discourage a knowledgeable buyer. An owner, however, has persuaded himself that his interests are better served by concocting an excuse for selling. Yes, it's strange. Why they're doing that? One of the true reasons is often, I'm fed up with that. I've had it. The owner doesn't wish to admit that he's reached his limits, that he's over his head. Burnout is an excellent reason to sell a business, maybe the best reason of all. It occurs in every enterprise. It's particularly prevalent when a type 1 individual who has founded the business has run the course. Often, however, The burnout entrepreneur will invent some other reason to cushion his ego. Look for the real reason, huh? When burnout occurs, the business often starts to slip, and that is difficult to admit, especially for that person who really started that. That is very difficult. I can tell you that from personal experience. The first time it happened, it almost destroyed me. What the hell is this? I thought. I can't run my own business. The second time it happened, it was easier to face. You're facing something like that? Have you been facing something like that before? Let me know. I will be glad to learn more about you and about myself. Sometimes a death has occurred in the business, taken either the owner or a key figure in the enterprise. The surviving members of the enterprise may be incapable of or may lack interest in keeping the operation going. Often an owner has overextended himself. He has more than one enterprise and has to sell one to save the other. On the other hand, he may be selling because he knows that the competitor is about to open around the corner. So what's bad about that? Wait. This should not discourage you. Competition can be positive, but it may force operational changes that the current owner is unwilling or unable to make. I know the situation. There was only one little store and then 12 around appeared. In 10 years, during 10 years, 12. And you know what? People still were coming to the first place. And they were even coming more and more people. They were bringing more people. Yes, they were telling stories about other stores that opened around. So what? It was fine. Yes, the workers, the person who opened the store was complaining a lot about that. But the number shows everything. The facts of the numbers. Okay, let's see more. Buying from a burned-out entrepreneur is often a good deal. He or she wants to get out and thus is willing to carry some of your paper. Help finance your purchase. You can walk into the deal with less cash and more credit. You see? Maybe good. Purchasing an established business, buying already existing business. So first question to ask is, why is the business for sale? Okay, the next paragraph is being smaller helps. In smaller helps. What does that mean? Let's read. It has become common for supermarket chains to sell off individual stores. What can be a losing proposition for a big chain may be turned around when the owner manages the store on the premises. He doesn't carry all the heavy overhead of the big organization. He can not only manage the store but can also double as his own produce manager or his own deli manager or both, with an owner on the premises. An additional benefit is that shrinkage will decrease and efficiency increase. Shrinkage in this case means goods that never reach the checkout counter for a variety of reasons, including theft, spoilage, and breakage. The big organization with the heavier administration problems needs sub-managers, regional managers who oversee a group of store managers and a manager who oversees the regional managers. There was a time when someone thought too many managers is bad. But I think time shows to those people. What's good, what's bad. And I decide that it's good, at least for me. While you should look with a grain of skepticism at the notion that you can make a go of it when the previous owner could not, you may be right. Not just because you're young, ambitious, and destined to succeed, but because you're looking at the operation with fresh eyes. If you've ever moved out of a house or an apartment, you may remember what a revelation it can be. I never realized, you'll say to yourself, how badly this room needed a paint job. The new entrepreneur walking in sees the need for sprucing up, refurbishing, repairing, and may therefore do better at the same location. So, change the manager. Let's see, how much is it worth? Oh, we can read how much is it worth here, huh? One of the major problems to face anyone buying a business is how to get at the truth about its worth. How to get at the truth? I don't know, let's see. It won't surprise the IRS, I'm sure, to read here that the typical entrepreneur has been spending the last 15 years trying to take money out of the business, keep book profits down, invent various expenses, and wait a second. Okay. Keep book profit down, invent various expenses, and in some cases just scheme by dealing in cash. This has been to his advantage over the years. It is not to his advantage, however, when the time comes to sell the place. The buyer asks to see his income tax return and is told, "What income tax? I haven't paid any income tax in 30 years." The same problem occurs when the small business person applies for a bank loan. If he's never claimed more than $9,000 in income over the last 20 years, it's hard to go to a bank and borrow money on his thriving enterprise. One of the best ways to solve this dilemma is to get the seller to agree to a deal, tying the sales price to a guaranteed gross income over a period of years, instead of relying either on the owner's books, a fictional tale of hand-to-mouth existence, or on his promises of incredible riches out of the rabbis because base it on verifiable performance. Let's say you've agreed on a $40,000 purchase price payable over a 3-year period. With 1 quarter done, he assures you that the business will gross $100,000 per year. You pay $10,000 down, 25%. The second $10,000 payment is due at the end of the first year, but only if the operation in fact grosses $100,000. If it only grosses $90,000, you pay only $9,000, and if it only grosses $80,000, you pay only $8,000. The same agreement would hold for the second and third year payments. A clause could also be written in. The seller might suggest that a sweetener be thrown into your payments if the business does better than $100,000 per year. You would also probably have to guarantee quality standards equal to those of the previous owner in maintenance, merchandise, and so forth, so as not to change the character of the business. Gross income works better for this kind of agreement than net income, since you may be following your predecessor lead in reducing your net. Well, if I'm reading too fast, let me know, write me a message, and I'll slow down and talk more about every detail. Just let me know. If your agreement stretches over more than a couple of years, you also ought to have a clause in the agreement that accounts for inflation. A gross income will creep upwards with inflation without producing more real income. An escalator should be built in, tied to an indicator. I prefer the Treasury bill rate to the consumer price index. Deflation should be addressed as well in the unlikely event that it should occur. That former owner may want to audit your sales so that you don't use the same methods on him that he used on the government. The wary seller will insist upon and is entitled to reasonable controls to be certain that the reported growth is an accurate reflection of the business. The world overflows with formulas about how to appraise a business, yet much of its actual value depends on what you are buying. Are you chiefly buying a location? Are you buying goodwill or inventory? What are you buying? Inventory purchases can often tell you a lot about the worth of a business. If the owner bought goods, something must have happened to those goods. The IRS, operating on that principle, uses purchased extensively when it examines a business. Even here, however, evasions are possible. A grocery store, for example, keeps 4 kinds of bread in stock. 3 show up on the books on the 4th, and the 4th is always paid in cash and is unrecorded. You're reading the book In Business for Yourself by Bruce Williams, Chapter 2, Getting Started, and this is about how much it's worth, how much the business that you can buy, the existing business, can worth. Okay, be careful about buying inventory. You can expect that the seller is not going to undervalue his inventory. It's up to you to decide whether his figure rings true. He may own 5,000 wide flowered ties, perfectly clean and well pressed, but nobody is buying such ties right now. Narrow, subdued ties are in vogue. You can't sell plastic flowers these days, especially older ones, even if they were purchased in the price your seller claims. Don't let him sell you stuff that left behind when he built the ark, or goods that he bought from his predecessor, like cool oil lamps. Not much call for them nowadays. Okay, don't buy the old stuff. So if you're buying inventory, check it out. What is in that inventory you're buying? A personal aside. Although I didn't buy them as inventory, I put myself in the same kind of bind early in the flower business when, against excellent advice, I bought trivets. I bought more trivets than somebody would need to go into the trivet business. Then I spent the next few years trying to get rid of them. I took them to flea markets, gave them away as gifts, marked the price down, everything in short, but hanging out in alleys and saying, "Hey buddy, want to buy a trivet?" I still have a lot of them. A trivet is a short-legged, 3-legged metal insulating tray, sometimes with a tile inlay. Do you want to have a trivet business? No, I don't. The value of goodwill, or as they call it in some places, blue sky, is even more difficult to price. If the present owner has spent 8 years establishing himself as the highest quality, lowest priced place for counties around, this goodwill is clearly worth something. This reputation was not established over a weekend. The customer knows that the item or line of items for sale there is inexpensive, dependable, and always in stock, and will come from miles around to get it. That's what he is selling, and that's what you're buying. You are paying for the time that he took to establish that reputation. As to how much it's worth, that's difficult to determine. Customer lists and mailing lists, if they exist, are included in goodwill. What are you paying for? Reputation? An accountant may help in analyzing a business. If the present owner shows evasiveness in any area, you should exercise caution in going any further into the agreement. The main thing to remember is that when you buy an established business, you are buying instant cash, instant turnover, and that's worth something. Something. He didn't say a lot. He said something. The next paragraph will be called restrictive covenants. Restrictive covenants. And today we read this to how much it's worth. Purchase an established business. How much it's worth. Being smaller helps. And why is the business for sale? Thank you very much for being here with me today. Thank you. I appreciate your time, and wish you to have a great pre-holiday. If you're celebrating, celebrate well. If you're not celebrating, have a anyway good time or good sleep, or like me, good coffee, good reading. And please subscribe to my channel. If you'd like me to read any other book, let me know. I will do that. And you can write me about yourself. I'll be glad to know about you. Thank you again.